glasses, skin and bone, almost. Hmm. One like already, one person has joined. How did the person know? Brandon. Good evening. What's up? How you doing, Brandon? Okay, let's start the live stream. Let me share the link everywhere. Then share my screen. So we're starting in 1 minute. We're starting in 1 minute. Let me just post the link everywhere so people can join. So on this live stream, I'm going to be explaining everything about FOMC, every single thing about FOMC. Then we're going to be trading it together. I'll give my prediction of the direction and also the reason for my prediction. So let's wait. We're starting in 30 seconds. I'm starting in 30 seconds. Okay. Let me share my screen so we can start. Please, before we start, help me like this live stream. Like this live stream. And if you have any friend who is interested in trading fundamental news, share the link to your friends so they can join. Okay, so they can join the live stream too. And when is okay, I want to. And when is all right, so I believe everybody can see my screen here. Let me open my pocket options. This thing. So today's live stream, we are going to be live trading FOMC. So we're going to be trading FOMC. I'm going to explain what FOMC is. I'm going to explain the tools that FOMC use to manage inflation and unemployment rates, which is going to be very, very crucial for you to understand what we are doing on this particular live stream. And then after giving all of those analysis, I'm going to explain to you what the current inflation rate is, current unemployment rates, and judge based on all those metrics. We are going to predict what the Feds are most likely going to do today. They're going to predict what the Feds are most likely going to do today. Okay, I've posted my stuff everywhere. Please like the live stream before we start. Okay, so this is going to be 5 minutes. This will be USD I know you're probably wondering why I have pocket options open here, because trading view sometimes can be laggy when it comes to data feed. Immediately a fundamental news comes out, it doesn't give the stuff immediately. It's not as fast as what they call it, pocket options. Pocket options is an high frequency broker, so their data is like in real time. But sometimes trading view can lag, and that few seconds lag can actually affect someone's what someone's actually doing. Okay, so let's go into the lecture of the day. So first of all, what is FOMC? Okay, FOMC is come let me type it here. What my prediction is and why. So number one, what is FOMC? FOMC is basically FOMC is an abbreviation of Federal Open Market Committee, and it's basically a branch of the US Federal Reserve. That's where you hear this, the Fed that decides monetary policy. Okay, so this is actually what FOMC is. Federal. They decide monetary policy. So when I say monetary policy here, what do I mean by monetary policy? Please drop your live on the group chat you are actually on. Oh, drop your live on the group chat you're currently on. We have 15 minutes to news. So monetary policy is how the central bank controls money and credit in the economy to keep things stable. You understand? So, for example, now in Nigeria, if you want to control how money moves in the economy, all right, you actually use policy to control those things. You cannot go and say, people, if moment be stop spending money now, if you should stop spending money, inflation is high. You can't tell people that. They will say, no, be you work for the money. Now me work for the money. Do you understand? And they will not answer you. You get, so the feds, what they basically do is that they use policies to control how money is being moved in the economy. So just know that's what monetary policy is. I don't want to go into explaining things, so I'm not to confuse anybody here. All right, so basically they control how money is being moved in the economy. Why are they important? They're important because they are there to checkmate mate uh, inflation. I said inflation and and unemployment unemployment guys rate. Okay, that is actually what they are meant to do. Now, you remember I said monetary policy, okay, which is basically how money is being moved in the economy and all of those things. All right. What is inflation? Inflation is basically increase in the prices of goods in an economy. Okay. So before we're buying carton of Indomie, let's say 7,000 naira, but it's around I think 13,000 naira or so thereabout. I don't eat noodles. You get, the price has increased. Okay, there was a time where to buy an iPhone, $1,000 iPhone was a certain price. All right, there was time when to buy a bag of rice, I think so, was probably around 11,000 or 12,000 or thereabouts. Now I think it's around 14,000. I don't know, but you understand that's called inflation, and inflation is usually caused when there is more money in circulation. So I'm going to try to explain this in terms of demand and supply. Okay, in terms of demand and supply. Let's say all of us now on this live stream, let's say we all have, how many are we? Okay, let's say we are 70, all right? And 70 of us, out of 70 of we are 70, let's say 10 persons, all right, have iPhone 17 Pro Max. So we have 10 iPhone 17 Pro Max that we want to sell. All right. And the remaining 60 persons want to buy the iPhone 17 Pro Max. All right. Now, if the 10 of us now that have the iPhone 17 Pro Max know that these 60 persons want to buy the iPhone 17 Pro Max, so they have money, they have plenty money in their pockets. We will not sell the phones for, let's say, 2.5 million. All right, we will not sell the phone for 2.5 million. The price which we are going to want to sell the phone for is going to be higher. Why? Because the people that want to buy it actually have more money. Do you understand? So when there is more money in circulation, the prices of things tend to go up. All right. When there is more money in circulation, that's why you see the president is trying to bring in tax this, tax that, put in tax. He's trying to increase this one, increase that one, just to kind of like take money away from the people, the citizens of Nigeria. Because if he takes money from citizens of Nigeria, then we're not going to spend more. And if you don't spend more, inflation is going to come down. You understand? So if 10 of us want to sell the iPhone and the 60 persons don't really have much money, the price will have to come down because we want to sell the phone. So that is just basically when there's more money in circulation, inflation occurs, the price of things go up. And when there's less money in circulation, the price of things go down. So inflation is basically the increase of the prices of goods in an economy, which is usually caused by more money in circulation. Now, next one now is unemployment. Unemployment. What's unemployment? Unemployment rate is basically the rate at which people are unemployed in the country. How many percent of? I think in US is like about 4.4%. In Nigeria, I don't know. Probably it's going to be up to 60% now. Let me check. What is the unemployment rate in Nigeria? Can I type very fast to Jesus? It's a lie. It's not 5 point something. Mona carry that rubbish come out from here. 33%. 33%. 33% of Nigerian citizens don't have jobs. So, you understand? So unemployment rate is basically the rate at which part the unemployed. All right. Now, if we have high unemployment rate, all right, that means a lot of persons are not employed. Abi. That means these people are not going to be making money. And if these people are not actually making money, they're not going to have money to spend. And if they don't actually have money to spend, inflation is going to be lower. Do you understand? But then, if we have a lot of our citizens employed, a lot of persons have jobs in this country, you understand? And they're earning what they call it, money. You understand? More money is going to be in circulation. People will buying cars, people will buying a lot of things because there's so much money in circulation. You understand? So unemployment rate, if it's low, inflation, inflation reduces. Okay, and if it is high, inflation increases. Bruno, do you understand? Then the next one, which is the last one, which they also um use, right? The last metrics is I think it's hourly earnings or so. I'm coming now. I want to get the exact name. I think it's hourly earnings. Okay, economic growth. No, e- economic growth. Yes, economic growth, which GDP is among, and investment. So what the Feds basically do is they monitor the rate of inflation, one. They monitor the rate of inflation, they monitor unemployment rates, and they monitor economic growth. So with these three things now, they decide if they are going to increase or decrease interest rates. So if inflation is high, they will do it interest rate like this. If inflation is low, they will do it like this. If unemployment rate is high, so they just keep doing these things to keep the inflation rate at a certain level. So in United States, the ideal inflation rate which the Fed want is 2%. They want to keep inflation at around 2%. That is what the Fed want to do in the United States. They want to keep inflation around 2%. Then unemployment rate, they want to keep unemployment rate from within 4 to 4.5%. This is their target for inflation, and this is their target for unemployment rate. So what we're going to do right now, because of time, we will leave this one now and we'll come back to it after the news have being released. The news is going to be coming out in 3 minutes. So let's go and focus on trading the news. And after, I'll come and explain a few things, and then we'll wrap it all up. Okay. So my prediction for this news is a buy on USD JPY. I'm not going to be able to explain the reason for the buy right now, but that's actually my prediction on the FOMC. After the news comes out, I'm going to break down why I went for the buy. Remember, this is news, all right, and it's forex, so you can't be 100% correct all the time. My accuracy with fundamental analysis is usually within 50% thereabout. If I take 10 trades, I'll usually win like five on a normal day when I'm actually at my days. You understand? So that is basically, if you want to trade this thing, there is what they call stop loss gap and slippages. But if you want to trade it, use just 1% of your account. You enter a buy position in 1 minute. You enter a buy position in 1 minute. Your stop loss is going to be 10 pips. Your stop loss will be 10 pips, and your TP would be 40 pips. Stop loss 10 pips, TP 40 pips. Stop loss 10 pips, TP 40 pips. In 1 minute, don't enter the trade yet. Don't you enter the trade yet. Don't enter yet. So if you're in BT Academy, wait for 30 seconds. Alright. But if you're entering it like this, you enter 1 minute, the news comes out. Okay. Alright, this is 1 minute. If you want to enter a position like this, you can enter a position now. Alright, this is 1 minute to the release of the news. Jesus is Lord. Wait, I'm coming. Hold on a second, please. What's the time at the moment? What's time? Is it 8 p.m. already? Enter your trade now if you want to enter. Please close all your positions if you entered any trade, please. Let's hold on a second and observe something. Okay, it's already going up. It's much slower. Fuck, like this. All right, let's see. So let's see. Let's see. Let's see. Let's see. Let's see. No, okay. I don't know. My time just got confusing. It was showing 8 p.m. Why TradingView was showing 1 minute to 8. So I got lost for a second there. If you enter your trade, um, you can close your positions now. This is like 1:2 RR. It didn't move much. It didn't move much. You can close your position at 1:2 RR. And if you're also trading too with the other method to close your positions now, FOMC did not actually move as much this period because of they didn't actually hike or reduce interest rates, but it actually bought as I predicted. So let me please close your positions now. Close your positions now. I've explained why you should close your positions. I've told you to close your positions right now, so I'm no longer in the position already. Should already I've closed my own position. Let me explain why I went for a buy on USGPY. I have to bring out my charts and start going through all this thing. Okay, so like I said, is the Fed's responsibility to keep where are all the things I wrote? I'm coming. I can't see my. Sorry, I'm just a little bit distraught. Is the Fed's responsibility to keep inflation within a certain range? Okay, to keep inflation within a certain range. So what they do is that they have two different things they use. All right, like I said, they are monitoring one, inflation, two, unemployment rate, and three, um, economic growth. Now, all these three things that they're actually monitoring, they are all interwoven. They are connected to each other. You understand? And they literally tell how good the economy of a country is performing at that particular point in time. If inflation rate is high, that means your citizens are most likely, probably things are not really as it should be because inflation rate is very high, everything looks very expensive. What type of country is that one? You understand? And if inflation rate is too low, things will be too cheap. That's also going to be bad for your country. So they have to balance it. I can't see what I wrote earlier. It has kind of like disappeared, but let me just type it here. So the Fed's balance for inflation, unemployment rate, and this is economic growth, which if economic growth includes GDP. GDP is what you guys produce in your country. It also includes investments and stuff like that. Unemployment rate of at which people are actually unemployed in your country is like, so their metrics for unemployment rate is 4 to 4.5%. All right, then inflation is 2%. So usually the Feds want to keep inflation at around 2%, and they want to keep unemployment rate within 4 to 4.5%. So if unemployment rate is like, let's say 4.2%, they're not worried because that's their target, provided it's not actually more than 4.5%. But then if unemployment rate grows to like, let's say 6%, 6% of the people in the country are unemployed, the Fed will swing into action. All right. If 6% of people in the country are unemployed, the Fed will do something to bring it down to this range. But if the if the unemployment rate is within 4.4 to 4.5, they're not worried. They're okay. That's their target. So the current inflation rate now in the United States is 4.4. Okay. Current inflation rate in the United States is 4.4%. So the Feds are not worried about inflation because inflation is currently within their range. They're not worried about inflation because it is within their range. Sorry, they're not worried about unemployment rate rather, because it's within their range. It's 4.4% right now, and their range is 4 to 4.5. The next thing now is inflation. They want inflation to be around 2%. Inflation is currently at 2.8%. So you see that inflation is higher than they would like. So that means the first decision today is going to be favoring, since unemployment rate is within their range and inflation is higher, their decision today would be favoring reducing inflation. So there are two ways they can reduce inflation. There are different ways, but I don't want to start going through all the quantitative tightening and all those things. I don't want people there to blow. So I'll just talk about the two easy ways that you can easily catch. All right. The first way is interest rates, and the second way is economic projections. All right. We also have quantitative tightening and easing, but I'm not going to explain all those ones. Quantitative tightening and so these are the things they use to actually adjust the inflation rate. So right now, inflation rate is actually very high. That means there is much money in the circulation. All right. So first of all, to actually explain how they use inflation to bring down, how they use interest rate rather to bring down the rate of inflation, you need to understand what interest rate is. Interest rate is the rate banks pay to borrow loans from the central bank. So if I'm a bank now and I want to borrow loan from central bank and the rate is currently 3%, so that basically means I'm going to be paying 3% interest on that loan I am borrowing from the central bank. Okay, and if the rate is, let's say, 2%, you see I'm paying less interest. Now if I'm paying less interest now from collecting loan, I'm definitely going to give less interest for people who are actually going to be taking loans from me. Do you understand? And if I'm collecting less interest, people will be forced to want to come and borrow loan from me. And if people are actually borrowing more loans, they will have more money. Do you understand? So this is low interest rate, 2% low interest rate, interest interest rate. So if people are actually borrowing loans from me, they will have, because I'm giving low interest rate, they will have more money. And when they have more money, they'll be able to use the money to, pay their mortgages. They'll be able to use the money to buy, invest in their businesses. They'll be able to use the money to, increase their sales and all of those things, employ more workers so they can boost sales, stuff like that. So low interest rates creates more money, and more money is equal to inflation. Remember, I explained that one earlier. Then, if the Feds increase the interest rate to 6%, 5%, this is high interest rate. If the banks are collecting, if CBN is collecting 5%, that means the banks are going to be collecting more. You understand? Me, I don't want to borrow loan, no. Because imagine me borrowing loan and now paying how many percent every single this thing for this thing. So people would less likely want to collect loan to pay anything. They'll just be managing what they actually have, JJ. So we'll have less money in circulation, and that's going to be this inflation. Inflation going to come down. So let me see high inflation. High inflation. This one is going to be low inflation. Low inflation. Are you with me? Okay. So these are the two things. But now come and see something now. This is the one. Either they increase interest rate or they reduce interest rate. So from these two things now, interest rates, inflation is currently high. What do the Feds want to do? they want to, it's higher than they like. They want it to be around 2%, but currently it's at 2.8%. So they want to reduce interest rates. How can they reduce interest rates? By what? So what am I saying? Sorry, I mixed something up. So inflation is currently higher than they would like. They want to reduce inflation because it's higher. Their target is 2%, currently at 2.8. So they want to reduce inflation. How they reduce inflation? By increasing interest rates. So the two ways in which the Fed can reduce inflation towards their 2% target is one, by high interest rates. This is called hiking interest rates, increasing interest rates. But as you can see from here, as you can see from here, let's open our FOMC. So let's open our, how am I mixing things up? Let's open our what do they call this thing? Forest factory. As you can see, the interest rate before was 3.75%, and the current interest rate is still at 3.75. That means the Fed did not touch interest rate at all. Instead of increasing it, they just left it like that the way it was. So that basically means they didn't use this interest rate to adjust inflation. So what else did they use? Economic projections. So I've explained what interest rate is and how it actually affects inflation. How Feds use interest rates by increasing or reducing to reduce or increase inflation. Okay. And then let me come and explain how they use economic projections to give to increase or reduce inflation in the country. So what is economic projection? You need to understand that the Feds are so powerful. They control monetary policy in the United States. If they want people in the country to have more money, they will do it. If they want people to have less money, they will do it. If they want people to have more money, if they want people to invest more, they will do it. That's quantitative tightening, which is basically them messing with bonds and stuff like that. So bonds are going to be cheaper because if bonds are cheaper, people want to buy more bonds. And when people buy more bonds with the excess money in their hands, they will have less money to spend. And that basically means they won't be able to drive up inflation by spending carelessly because now the money is tied to investment. And if they want people to move their money from the bonds, they have the way they will just take and you get, so they have the, but I'm not going to go into those ones. So I will not scatter anybody's head. Let me just explain what economic projections is. So a lot of what do you call it? Organizations, banks, government bodies that controls things like loans, this one, government grants, stuff like that. They are constantly watching um, FOMC, the Fed, to know if they are going to release money into this faction or remove money from this place or increase this one or reduce that one to like adjust inflation, and everything. So whatever the Feds do or say, people are watching it and they're actually acting on it immediately. You understand? So when you say economic projections, what do we mean? We have two types of economic projections. From their tone, it's either the economic projection is either hawkish or dovish. Dovish. So when they give an hawkish tone, it's basically hawkish tone. It basically means they are concerned about inflation. Do you understand? So despite the fact, if you look at this, your forex factory here, you will see that what they call it. If you observe your FOMC, you notice that the forecasted figure of the interest rate is always equal to the actual. So if the forecasted figure is showing 3.75, that means these guys are not going to reduce any interest rates. Look here, forecasted was 3.75, actual was 3.75. Here forecasted reduced to 4 point, actual was 4 point. That's how it used to be. It's always like that. So before the new 7 comes out, we used to know if they are going to increase or reduce interest rates. So seeing this now, knowing that they're not going to increase interest rates. They're not going to hike it. The next thing that came to our mind was the economic projections. And hawkish means they are concerned about inflation. If they are concerned about inflation, USD is going to gain strength because if they are concerned about inflation. That basically means that in future, if inflation does not come down, they are going to increase interest rates. And if they give an hawkish tone, that means they are likely going to increase it in future. It will make USD gain strength. And if USD gains strength, USGPY buys. So now you see why I went for USGPY buy here, because they are not increasing interest rates. Inflation is still high. So the only thing they want to do is they want to use economic projection to like talk about how interest rate is a bit sorry, how inflation is a bit high and how they are likely going to increase in future. And if they give an hawkish tone, concerns about inflation, USGPY buys. Now how much USGPY buys is all going to be influenced by how hawkish their tone is. So if Paul comes and say, "Hey, anyway, oh, Jesus, inflation is high, oh, my mama, oh, I don't die, oh," you see it just be going. You understand? But if he comes and says, the economy is balanced, we are not really worried about everything. Everything seems to be normal, but there's just a little bit concern about inflation. But we are going to be monitoring it. We are going to be monitoring it for now, and we may increase interest rates in future. We may, if inflation doesn't reduce in within the next couple of months. So you see, he's talking about them likely going to them likely increasing interest rates. You understand? Because they are slightly concerned about inflation, slightly. So that's what they actually did right now. Their tone was hawkish, but it was slightly hawkish. That's why USGPY that's why USGPY bought slightly by just about 20 something pips. Okay, that's why it bought by just about 25 pips. But if they came out and they were like very concerned and worried, let's assume it's very high and their tone sounding as if they are scared they're going to rise, because they can say, oh, it's still at 2.82%, but the way it's moving, it looks like it's going to rise very, very well. So we are likely going to cut high rates in future. That's very hawkish. USG power flat. So the moment I looked at the USG price stuff and I saw that it not move very, very much, it didn't phew, all right, it didn't move very well. I knew that okay, their tone was slightly hawkish, and that's why I told us to exit at this particular point because they have said what they want to say. What else? If it's very, very hawkish by now, within 1 minute, it should be around here. Slightly hawkish within 1 minute is here. Are you with me? So that is basically why I went for my prediction. How many pips did it even climb by? Was it up to 25 pips? Yeah, 25 pips. I was correct. How long did it take the market to move by that 25 pips? So let's see. Okay, so that is it about that. Then when they come out and see they are less concerned about inflation, less okay, dovish tone, less concerned about inflation. USD JPY sells. And the more dovish their tone is, all right, the more USGPY is going to sell. So if they come and say, hey, we're not concerned about inflation, oh, it's not really our problem right now. You just sell. So if they come and say, they sound more dovish and all, it's going to move this. So these are two things the Feds used to adjust inflation. I'm not talking about unemployment rate right now because unemployment rate is normal. They have no issue with unemployment rate. I'm talking about inflation because inflation is what they are looking at. So the next FOMC now they will observe this inflation, this thing. If this inflation stuff does not reduce to let's say 2.6 or so, if it does not reduce to 2.6, it does not reduce lower than, because I'm trying to bring it down for a while. If let's say in the next 3 months, the next FOMC, let's assume the inflation rate is still 2.8% or it will increase 2.9%. That's when the Fed will be like, nah, 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 we ain't doing this shit no more. It will just be like, interest rates rise, rise, rise. They will not come and say they want to increase interest rate, bam. They will not give interest rate, they will now give a slightly hawkish tone again, then to now move up very, very well, you understand? But this is what they did. Did I confuse you guys, or do you actually understand all the things I talked about on this call? I know I've been talking since for like almost 40 minutes. Did I confuse you all? You have any question? Drop in the chat, in the comment section, chat box. Let me answer before we end the live stream. If you have any question, drop in the chat box so I can answer your question before we end the live stream. Any questions? Any questions? Any questions? Any questions? Any questions? Do we have any question? All right, so that's basically it for now. The last fundamental you're going to be trading for USD is going to be PPI. That's Producers Price Index. Okay, and that's going to be, I think it's on Friday or thereabouts. It's on Friday. On Friday by 2:30 p.m. So as usual, I'm going to be coming live again, and I predict this one is going to move well. That's my prediction. So just set your alarms, and that was a nice 20 pips we cut. See you guys in the next live. Have a lovely, beautiful, and amazing day. And if you got value from the live stream, drop value on the respective group chat you are on. Have a lovely day. Bye.